Hi everyone, I'm McKinley. Welcome to another episode of the Rick's Picks Show. In my role as a wholesale and mini-core account executive, I'm consistently presented with the scenario of folks trying to utilize conventional financing with DTIs exceeding 50%, which, as we know, is a problem. Now, in order to keep your clients' purchase or refinance dreams alive, you're going to need to assist them in strategically reducing their debt ratios. As a part of your process, you may find that attaining a specific DTI threshold like 50% and rerunning AUS still has LPA and DU saying no, meaning you have to go back to the drawing board and see what else you can do in order to get an AUS approval. It's kind of like that scene in Apollo 13 where they're trying to power up the lunar module out in space and an astronaut on Earth is in an identical lunar module flipping switches strategically to allow the machine to come to life without killing everyone else in the process. Now, while your scenario probably isn't life or death, your borrowers are out in space, running out of options, and they need your help. You are that astronaut at mission control, strategically finding a solution for your clients that's going to bring them home. Literally. Okay, enough of the drama. Let's talk about options to lower your borrower's debt ratios. Before we determine which method is going to be the best fit for your scenario, we first need to figure out how much of the borrower's monthly outflow needs to be reduced to stay within the product's approval guidelines. Everything is on the table, and this includes examining the proposed PITI and MI payment as well as all other current liabilities. For starters, take the percentage of DTI you need to reduce multiplied by their monthly income to get a target dollar amount for payment reduction. As an example, if you have a borrower that makes $10,000 a month, and your current ratio is 53.5%, you know your DTI target for AOS approval on a conventional loan is 50% or less. You're going to need to reduce that DTI by at least 3.5%, which equates to $350 in monthly payments, or $10,000 times 3.5%. Now, once you've nailed down your target dollar amount for monthly payment reduction, you can employ the following tactics. First, maybe try increasing the down payment or reducing the loan size. This is the most obvious, but also the least efficient method of reducing the borrower's DTI. If in our example, our loan amount was originally $350,000 with a rate of 6% and a P&I of $2,098, reducing that P&I by $350 and effectively the DTI by 3.5%, the loan balance will need to be reduced by $60,000. That's $290K times 6% equals $1,738. So you can see this is pretty inefficient. Now, another more efficient option of reducing debt ratio and total monthly payments is to reduce other debt. Take a look at the credit report for the lowest balances available for payoff first, and then of those, look for the ones with the highest monthly payment. If they're not already being excluded for being under 10 months, those are the ones to focus on. Now, as a side note, underwriters have the burden of prudence in making the judgment call on whether or not they should include the payments with less than 10 months when they're calculating debt ratios. So, if the ratios are tight, like they would be in our example, they're most likely going to count those payments in the debt ratio calculation in order to prevent an early payment default. So, you'll want to consider the payoff of all the low balance items at closing, and if needed, move up to higher balance payoff, since this is a more efficient reduction of monthly outflow. Please let the settlement agent handle the payoffs instead of attempting to pay items off prior to closing. You'll thank me later. Next, if paying off additional debt doesn't completely fix your debt ratio issue, you could also consider looking at the homeowner's insurance. Now, with all the premium increases we've seen across the country, it might be time to forget insurance agent loyalty and do some price and coverage comparisons. You might be able to save more than $100 a month by avoiding a big box insurer that pays big commissions. You could also consider increasing your deductible for additional savings. Just make sure that your coverage and your deductible meets the requirements of the investor you're selling to, if you're not servicing this yourself. Another thing you could do is buy the rate down. Now, I'm not talking about a temporary buy down. That's not only not a long-term solution, but it also doesn't help you with the qualifying DTI. Look at paying discount points to get a lower permanent rate. The discount points spent will be a much more efficient use of available funds for reducing P&I and subsequently the debt ratio. Finally, if you've looked at everything else, maybe it's time to consider a different product. You might be getting pressure to utilize a Fannie Mae fixed rate loan. But maybe that means looking at an ARM instead of the fixed rate, or stretching out the amortization to 30 from 15 or 20, or maybe it means looking at FHA, which not only has great interest rates, but also lower mortgage insurance for those that are above 80 LTV. And debt ratios allowed above 55% in some cases. You might even want to look at a non-QM option, which could allow for higher ratios or different ways of documenting qualifying income. Explore everything at this point and maintain that relationship, because if they go across the street, they could take their other businesses with them. And that wraps up another Rick's Picks show. If you have any questions on anything we've talked about today, please don't hesitate to reach out. I am an account executive after all. Thanks for watching, everybody. Have a great week. See y'all next time.